The Hobart property market. What do you know right now about what's going on in the Hobart property market? It's just over 1 hour flight from Melbourne, yet it remains an enigma to most property investors. Today, I solved that puzzle for you. So if you're interested in a full Hobart market update, you're in exactly the right place. And today is not going to be like anything you've seen before, because in this video, we're showcasing for the first time a new way of showing you our data-driven approach. You'll see the data, then I'll educate you on what the data means to Hobart and you as an investor. And at the end, I'll give you my prediction for the next 6 months and beyond on the Hobart property market. Remember to help out the channel by clicking the like and subscribe buttons. Let's get straight into it. Chart 1 isn't as strong as we'd like it to be. So what we're clearly seeing is price pressure has reduced substantially. There just isn't the heat of the market here that once was. What's interesting though is the rental market still remains fairly undersupplied, with rental pressure moving upwards. So you can expect rental growth and rental yields to keep growing. This is an important part to discover in markets that have been slow in recent times, particularly like Hobart. When rents continue rising and price pressure remains low, yield ends up rising. And yield can have a flow-on impact in years to come. For example, rental yields rising can make investors start to get attracted to an area because they're seeing the rate of rental return increase in their favor. Rental yields increasing can also make tenants go, well, I'm not really enjoying paying more rent whilst prices stay the same. Can I find opportunities to potentially consider actually buying in this market? And rents also rising when it comes to rental yield makes those who own property there and then might be having a change of life or circumstance look to consider keeping the property because of the rental returns they might be ending up getting, and it keeps markets lower supplied over time. When it comes to rental yields, it isn't as low as some of the major cities of mainland capital markets, but also it's not crazy high of the regional cities. Let's look at affordability. So Hobart, even though the growth has been huge, remember in recent times, wages have been picking up a lot. And in recent times, Hobart's growth has not been great. So the affordability aspect has actually improved. It's not very affordable. It's not absolutely unaffordable. So it's parked in that middle territory. Incoming supply was actually a weak scoring metric earlier on in the last few years because building approvals rapidly picked up. But now incoming supply is balanced out again, more of a balanced rating, not low pressure, not high pressure, quite balanced. The growth cycle, though, isn't scoring so well. Many people are thinking of Hobart for now, but actually don't realize that it's been one of the best performing markets in the recent decade. If you go to that sort of 2015 to about 2021, there would be very little, if any, markets that did as well as Hobart did in those 5 years. Now, during that same time, Melbourne, Sydney, some of our biggest capital cities literally were falling between 2017 to 19. During that same time, Perth was declining heavily. During that same time, Brisbane and Adelaide between 2015 and 2020 were actually very flat. So it just shows you that it's important to recognize just because Hobart's cycle or growth periods are weak now, it doesn't mean that Hobart is a bad city or Hobart is a city that won't perform as part of a long-term portfolio. It's about realizing that there are times when Hobart was performing as well and nowhere else was. In this case, though, Hobart's growth cycle is not ideal. So overall, chart 1 is not looking so great across overall metrics of scoring. So what we're seeing in chart 2 is some of the economic trends here. Now, what we can clearly see is that the internal migration has been quite poor in recent times. Population growth percentages were very, very strong in that sort of 2015 to 2019 period. But since then, it's really come off in recent times. Job market, we've actually seen a big pickup like most parts of the country when it comes to job advertisements. Job advertisements picked up and that helped some of the growth in the earlier parts of the boom. But in recent time, job markets have actually peaked and they started to come off a little bit, but they're still fairly high and above the averages. When it comes to unemployment rates, it's still fairly low in line with what's happening across the nation. If we move over to the sales market trends, here's what's interesting, and this clearly shows the pressure valve in Hobart as not very strong right now. We can see days on market has lifted pretty heavily, and the trend is quite clear that from 2022, days on market pressure has not come off. It's continued to rise, continue to rise. In recent times, a small amount of stabilization, but not enough to say that the flat times are over. Right now, days on market lifting and then seeing median house prices come back a little bit isn't a positive sign. It's essentially saying that we've had longer times to sell and price declines, with price declines now flattening a little bit. But I guess it's not a good sign to look at it from the perspective of a buyer's market, right? It is a buyer's market in that avenue that it's easier to buy, but it's not a good sign if you're trying to make short-term capital growth, because we are seeing days on market lift up. The pressure is coming right off, and it has been over the last year to 2 years. When we look at the demand and supply aspects in chart 5, what's clear to see is sales volumes have really been pretty weak in recent times. It's also clear to see that listing volumes have actually increased, and they're hovering up and down at that increased level. Now, you'll see from sort of the last couple of months with more seasonality, it's come off a little bit. But when you see this black line, which is the combination of both listings and sales volumes, listing levels and sales volumes are actually heading in the wrong direction to each other. Sales volumes are declining a little bit, listing volumes are still pretty high. So what's happening? Inventory levels increase. Just to refresh you on what inventory levels are, 10 sales in an area and you had 30 listings. If the 10 sales are the average per month, it would take around 3 months to clear all the listings if you decided no more listings were going to go online. Now, anything in that sort of 3 and below is a strong amount of inventory, which indicates low supply and a decent amount of demand. If we go to chart 6, the supply levels, they were scoring weak in terms of incoming supply earlier on. However, incoming supply is starting to improve, so that score that we talked about has returned to balance, with recent years of building approvals being quite low. If these building approvals continue to get lower and lower for houses specifically, then that will improve future supply in terms of it being quite constricted. It's also key to note, though, that we want the population growth rate to also be healthy and happy, all whilst building approvals stay low. And that's just one thing to keep a lookout, because in the previous years, we had low building approvals in the growth years, and we had population improving, and then the growth cycle really kicked off as one example. If we move to the cycle perspective itself in chart 7, you can see that the 10-year growth of Hobart has been a top performer, as I pointed out earlier. So by no means is it a bad market to have in your portfolio, but from a timing perspective, you can see that the big run was sort of in that later part between 2015 and 16, all the way up here till 2021, and in 22 and 23, unlike some other markets like Brisbane that went straight and flattened and then went up again for 2023, or Adelaide that continued to boom every single year, or Perth that continued to pick up as well, Hobart did go the other direction. So it does mean its cycle has flattened out a little bit in recent times. Although on a 5-year and a 10-year basis, still performing quite well, it's just in the recent couple of years, it hasn't done too well at all. If we're looking at the rental market, we pointed out at the high pressure in this rental market. So it's clear to see that rents are going to continue to rise. A little bit of flattening perhaps to do with rental affordability, but it's clear that the vacancy rates are that low and remain low that we should expect rents to continue to rise, which means if prices are flat, rents rising, yields will rise too. Speaking of rental yields, this is the next chart. When we're looking at rental yields, we are above the capital city average. But to be honest, Hobart should always be above the capital city average. And you can see in the most recent year or two, it has been. Why I said it should always be above the capital city average, it's not as large as a Sydney, Melbourne, Adelaide, or Brisbane as a market. And with that, investors do tend to expect a little bit higher rental yield if they're going to that smaller town. And so also in this particular case, we can see that Hobart's rental yield is above the average of capital cities and increasing. We do expect this to increase at a sharper rate as rents continue to pick up, whilst the actual prices still stabilize or come back. When it comes to the long-term rental trend, we're seeing Hobart really pick up in terms of the earlier parts of the decade, but then in recent times, there is a bit of flattening. Now, I'm led to believe that that could be due to the actual rental affordability, but when it comes to the actual averages though, look at Hobart's 10-year performance. It's been a massive market from rental growth. This sort of rental growth that's happening in Hobart over the last decade may mean that affordability of rental markets is starting to be reached a little bit, because we're seeing it flatten out and it's way beyond the average of capital cities when it comes to performance. 39% for the greater capital city average and 75% for Hobart. So it's been a great decade for investors overall. It's just that it's taking a little bit of a well-deserved break. When it comes to Hobart, I guess the key things to talk about is what I just mentioned then. It's performed exceptionally over the decade. If you're looking at a diverse economy, a strong economy, with jobs advertisements still at high levels, unemployment's low, you're talking about an area with great lifestyle, great quality of life, and then you're talking about it from its beauty as well. There's a lot of things going for Hobart. It's just that in recent times, places are taking longer to sell. The rental market, in terms of its growth, has faded a little bit, although vacancy rates are really low. And we can see that prices have come off as well since 2022. I think it's fair to say that right now, when it comes to Hobart, we don't see any major recovery or growth over the next 6 to 12 months based on the recent trends in play. Now, obviously, interest rates are a common reoccurring theme that are showing up, and we are starting to see people want to beat the party when it comes to interest rates, or beat people to the party. And so that may bring up a little bit of a sugar rush in Hobart. But right now, if you were to put the interest rate macroeconomic cycle aside and just look at the trends being displayed in Hobart, those trends aren't really positive. I think instead of a growth market over the next 6 to 12 months, it's more so just Hobart trying to find its feet, flatten and bottom out, and do a very much an average year or below average in terms of growth. However, when you factor in all those aspects, we talked about rental yields and rental markets picking up. The milder pace is there, but in the long term, once we see Hobart come out of this phase, we're seeing low housing supply levels. We're still seeing a thriving economy. We're still seeing healthy infrastructure improvements, stadiums, and other things like that come into the mix. The robust growth will come back again. It's only going to be a matter of time. Yields are back up above our average capital city yields. Rental vacancy is tight. Incoming supply is dropping off again. All we're missing is a couple of macro fundamentals in terms of the popularity of the city as well, from a couple of factors like population as one, but not a main driver. We're also looking to see days on market reduce again. We're looking to see price pressure pick up. And then off the back of that, that will all come together with rising yields, low vacancy, improving economy, diverse economy, great lifestyle, reducing days on market, and high pressure. You would have seen some other videos where I've actually shared more about market pressure, and they've actually been on the up. So this is probably the first video where we've seen me talk about how pressure's been weak and weakening in recent times. And this shows you that we're here to really give you the truth on cities, what the data says, what the fact says, not our opinion, not bullish focus on property, not bearish focus on property. We're here to give you what the facts say. So when it comes to Hobart, the short version of this all is that Hobart's next 6 to 12 months are going to look pretty average, and then keep an eye out on the market. We'll revisit this market as well. And when we revisit this market, we'll see if that yield curve starts to increase again because vacancy rates are low, or does affordability block it out? Is the strong economy and the resilience and the diversity of the economy with the great lifestyle going to start making people come back to the city again? And then lastly, when it comes to the price pressure, are we going to see that return again, or is that really just found a balance point? It'll be interesting signs to watch, but right now Hobart is pretty flat, and we expect it to be like that for the rest of the year. And it'll be interesting to revisit this topic again next year.